Hope you're all well. Fantastic. Good to see. As we are waiting a couple of minutes, today we are going through the position trading as one of the strategy in the Vantage Trading Strategy Masterclass. If you do have any questions at any point in time, trading related questions, please feel free to put it into the chat and let me know. I'll be happy to help you through your questions. And if you do, and if you can as well, put into the chat, let me know, do you actually, what kind of trading style do you deploy with your trades? Are you a short-term trader, swing trader, scalping or swing, or do you do position trading, super long-term? Swing trader, fantastic. Very seldom do I see FX traders in particular taking on a position trading strategy, just because that it does take a long time for that trade or for the trades to play out. What about you, Bendo and Sumit? How do you guys trade? What kind of trading strategy do you deploy? Alrighty, let's get started. So again, welcome. Thank you all for attending this session here with Vantage on a Trading Strategy Masterclass, part 3 of 3. What we had before in the previous sessions, where we did, I think part 1 was scalping, part 2 was how to do swing trading, and now part 3 is position trading. You realize that scalping was super short-term, very quick trades, very almost opportunistic trades. And then we had swing trading, which was more medium term. You would hold on to it for a couple of days, a little bit longer period. And then now we're looking at position trading, which, is a very long-term style of trading. Basically, you're trying to ride the trend through several smaller trends or multi fluctuations in price. All right. So it's going to be quite interesting. Not many traders do take on this kind of trading strategy, but it is also a way that, if you don't have that much time to spend looking at the charts or sitting at the screen every day, this might be something that you want to consider, test it out, deploy it when you're confident and ready. Could be quite beneficial to those, especially short on time, but do want to take advantage of the price movements in the market. All right. So with that said, let's get started. My name is Jindao. If you are joining us on Zoom or on any other streaming platforms, please feel free to ask any trading related questions as we go through the slides. If you come across any, put it into the chat. Let me know. I'm watching not just on Zoom, but I'm watching across the other chat platforms as well. So I'll be happy to address your questions as they come around. So before we get started, as usual, a quick disclaimer: the information, context, opinions which are expressed in the presentation and in the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. Vantage does not guarantee the accuracy or reliability of the information provided herein. What it means is that quite basically is that as we go through this educational session about position trading, do make sure that whatever you come across or you learn, if you do want to try and learn it and deploy it into your own trading strategy, what I always suggest is first, read more about it, find out more, learn it properly. And then after that, test it out. Test it out on a demo account first, right? Test it out, back test it, and forward test it on a demo account first. Then after that, try it on a smaller trade size. Following on from that, once you gain that confidence, once you gain that understanding, then you could start deploying it into your, fully deploy it into your trading strategy. All right. With that, just a quick introduction of the team here at the Everest Fortune Group. My name is Jin Dao. Most of you will know me as Jin. I'm one of the prop traders here at the Everest Fortune Group. I have been trading for, I always say 10 years, but it's 10 to 15 years now already. Been quite a long time. So if you do have any questions, trading related questions, do drop me a comment. Let me know. I'll be happy to guide you through that. And also, what I would say is that the way I trade, right? My trading strategy is a little bit different from what you would normally come across. The way I trade, I do look at the fundamentals first. I pay a lot of attention to economic data, release, the change in economic data, fundamental analysis, forming my directional bias based on the fundamentals first. And then from there, I look into the charts to identify the possible swing levels in terms of the support or resistance levels, and also the way price is moving, right? That's why I'm doing this session here in terms of the position trading, because it does fall in line with the way I approach the markets, looking at fundamentals quite a bit. Then after that, looking into the charts to identify possible levels where we could see price swinging towards upside or the downside. So we have quite a number of things to get through today, right? Quite a number of things to get through today. First of which is, what is position trading, right? What is position trading? Give you a brief introduction of that. How long term? I've been saying it for so many times already, even in the first 5 minutes of this session. Position trading is for the super long term. How exactly long term it is, I'll guide you through that. It is a combination of looking at both the technical and the fundamental analysis. By which proportion, what to pay attention to? Do you have to look at everything, or do you have key news events, key fundamental events to pay attention to? And how much of a technical analysis should you do? We'll break that down for you. So that's part 3. And then the important question everyone does ask is, how much time should you have to trade these strategies, right? As I was telling you already, this is really a strategy for someone which has, not a lot of time, or doesn't want to spend a lot of time sitting in front of the screen watching the charts. It's a approach that you can take on a bit more hands-off or hands-free, where you would get into a position, hold it for the longer term, just to ride out the position, right? You try and maximize on the swing or on the move of the prices. Okay, so how much time should you have to spend to use these strategies? And then lastly, I'll give you some examples on position trading strategies, right? I'll give you some examples of what has happened, so you can start thinking about how to deploy this into your own trading methodology, right? And if time permits, what I'll do as well is I'll jump into the live charts and possibly identify some potential levels that we could be looking at as a position trading opportunity. But bear in mind, again, the disclaimer does apply. If we do look into the live charts, if we do look into looking at possible position trading opportunities, if you do jump into any trades, please make sure you do your own due diligence. Don't just jump into it just because we talked about it in this session. What I want to do is really just to show you how it can be deployed quite similarly with this strategy. Okay. All good for now. Any questions? If you got no questions, first off, what is position trading? Okay, it is really, we've said this so many times, a long-term investment strategy. I'm almost at a point of converting, when I was doing these slides, I was almost at a point of converting all the terms when it says trading to investing, right? Why so? It's because when you're trading, it's more towards the short term, right? It's more towards the short term. It's more towards reacting. So in my view, when I look at trading, oops, can't write it, can't scribble properly, right? I'm thinking of it as a reaction. Right? It's more a reaction to the way price is moving. Oops, trading, right? It's more a reaction to the way price is trading. You're trying to get in, make a quick move, make some profits there. When I talk about investing, right? When we talk about investing, it's more about prediction. I know I am scribbling a little bit, just bear with me, right? You're trying to predict where prices could reverse from, just so that you can find almost at the top and swing it, or not swing, but get into a position so that you can ride the whole wave down or the whole wave up. What you also should be considering is that when we're looking at trading or investing, this is shorter term and this is longer term. That's also why, as I was doing the slides and preparing the slides here, I was thinking that, because we're talking about position trading, and because we're thinking of it being long-term investment strategy, we should be thinking of it more as investing, trying to predict price movements, rather than talking about trading and trying to react to the way price is moving. Okay. More importantly as well, when we talk about position trading, you're looking at getting into a trade or position which you'd most likely hold on to it for several weeks. That would be considered a very short-term position, right? Weeks, months, or even longer, could be years, right? Could be even years. I would say most traders, especially during these sessions, would not hold a position for years. At the most, we'll be looking at several months, 6 months at the most. That's still considered a good position kind of strategy. The aim of position trading is to profit from long-term trends, right? You're looking at long-term trends rather than a short-term price fluctuation. What we mean by that in terms of long-term trends is that you normally see price move in, for example, that upward direction, right? That's the long-term trend. But most often what we've seen a lot of traders do is that they take advantage, or they're trying to take advantage of the short-term price fluctuations when it does this, right? They're trying to take advantage of that move. And I scribble terribly, but in the overall sense, it's like that. All right. So they're looking at either, buying for the short term or selling for the short term. A lot of times traders are looking at the shorter term fluctuations. In terms of position trading, you're looking at buying at that point and then closing out at that point, right? You're trying to maximize on the swing. And you can see that this would end up with a lot less trades, but a bigger potential profit, right? Bigger potential profit. But we all know if you're trying to predict the market, it's not always going to work out. If it's not always going to work out, your risk is also going to be higher. Why do you think your risk is going to be higher? It's because you are trying to figure out where the bottom or where the top of the market is. And also because if you're not entering as many trades over the similar period of time, what you might end up doing is, or having to do, is to enter bigger trades. I'll get into a bit more details about that shortly. Any questions at this point so far? Have I lost everyone? Are you all good? Let me know, put it into the chat. All right, good stuff. So with that, why would you want to take on a position trading, given that we're talking about, higher potential profit, but also bigger risk? First off, we know that it's a super long term. It's going to be for trend followers, right? You're going to see where the price is moving. There are two different approaches, slightly two different approaches to position trading. One of which will be, as position traders, they see price coming down, right? They identify a key support level in this case, and then they'll be looking to put in buy orders just to try and predict where price could be bouncing off, right? They'll anticipate that price could bounce, looking for it to bounce off and move towards the upside. That's one approach. The other approach is, as traders, position traders would do, is look for price to drop. Only after it's bounced, then they'll get into it with their buy order. Right? One is trying to predict, and one is trying to get in a little bit earlier than that. So it is for trend followers, because you do identify longer term trends as price test key support levels. It does not require much activity or time, right? In fact, what we have actually seen is that, there might be one or two good trades that you get into, and you might hold it for 3 to 6 months. So very low, very low trade activity, very low trade volume for a position trader. Okay. And then you also identify entry and exit prices in advance. You're looking at price dropping. You're looking for buying or entry opportunities and take profit levels at key levels. Again, you've done all that before you even get into a trade. Or you identify the levels in advance before you get into a trade, just so that when it triggers, you have everything all set up. And also you have a tight risk control with your stop loss orders. Remember, stop loss is going to be crucial in this kind of scenarios. Because we are looking at that potentially big swing, right? So in this case, if we bought there anticipating for price to push towards the upside, your stop loss would have to be below that key support level, right? That key support level. I'll tell you more about stop loss and why it's going to be quite important and very important as well. Okay. Position traders take on very few trades. Like I was telling you, they go on, you'll be lucky if you have 2 or 3 trades in 3 to 6 months, because every trade or trade that you're looking to get into will be something that you'll be looking to hold for a longer term, right? So you wouldn't be having too many trades because you can't identify all the position levels or the big swing levels. And also, when you get into a trade, your exposure is there, right? Very often, most of you will understand that you can't have more than, based on your capital amount or based on your trading style, you're not going to have more than 2 or 3 trades open at a time. So if you are doing long-term trading, in terms of position trading, once you have a position open or 1 or 2 positions open, there might be your leverage all maxed out. There might be your leverage and margin all maxed out. You'll be sitting there waiting for the price to move towards where you anticipated or planned for it to go. Okay, so very few trades, often holding on for months or year, riding the longer term trend. Most importantly is that because you're not going to be sitting there watching the charts, checking every price movement. This would be a kind of trade where you get in, you set your orders, you leave. You don't even check it for a couple of days or a couple of weeks later. When you anticipate that prices could change or there's a shift in fundamental scenarios or fundamental environments, then you check back onto your charts to go, okay, has my trade triggered? Or is that trade idea or that trade setup still valid? Do you want to cancel that order or not? Okay. So you're ignoring short and medium term price fluctuations. Okay. And then your fundamental themes, right? A lot of times when I talk about trading and when I mention fundamentals, most traders will go, not going to pay attention to it because fundamentals is too hard. I'll filter it down to 3 main things that you'll pay attention to. You can ignore a lot, if you're looking at position trading, you can ignore a lot of different or smaller news that could cause prices to spike because you are looking at the longer term kind of news events. What I mean by that is, I'll go into more detail of that, but what I mean by that is, for example, the non-farm payroll. Right? Just as a question here, are you guys familiar with the non-farm payrolls? Do you trade the non-farm payrolls? The NFP, first Friday of every month for the US. Good stuff. All right. So what happens, or what typically happens for the non-farm payroll? It's viewed as a very important news event. Right? Why is it a very important news event? It's because whenever that data gets released, you see price spike down very sharply or spike up very sharply, and then could continue lower. But then that's in a short term, at that moment. But if you zoom out to the longer term, it's actually going to look like a big spike down before retracing and then continuing back up again. Okay, I'll show you an example of that later on, in a short term on the non-farm payrolls, and if you were looking at it as a position trader in the longer term. So I'll filter down to a few items that you pay attention to in the fundamental analysis point of view. Okay, but fundamental themes become the predominant focus when analyzing markets. Why is that so? It's because when we look at technicals, it could be short to medium term. Only when we look at central banks introducing new strategies or new policies that shifts the overall economic, or potentially shift the overall economic performance. And that's where we can see a big change in direction, giving us the opportunity for longer term trade opportunities or longer term trade ideas. Okay. Here's an example. This is gold. Okay, this is gold. And this is, if I'm not wrong, on the daily time frame, kind of charts. So when you're looking at doing position trading, you wouldn't be looking at the M15 or the H1 time frame. Even the H4 seems a little bit too short term. If you're looking at position trading, what you'll be paying attention to is more on the daily time frame or even the weekly time frame. Just answer your question there, Sumit. Okay, you most likely pay more attention there on the daily or the weekly. I wouldn't be looking too much at for sure not on the H1 or even the H4. Right, I would say the H1 and the H4 will be more for swing trading, right? And then anything less than the H1 time frame will probably be more for the scalping kind of trading strategies. So when we're looking at swing, we're looking at the daily. Oh, when we're looking at position, sorry. I'm getting better at my scribbles. When we're looking at position trading, we're looking at more on the daily or the weekly time frame. So again, this is gold. This is gold on the daily time frame. And you can see that we're looking at that overall directional move, long term. This started in March, 1 month, 2 months, well, not March, April, May, June, July, August, September, October, November. All right, so 1, 2, 3, 4, 5, 6, 7, 8, 9 months. You would be looking at a 9-month period on this one trade. right? And why would you be looking at this? This is where you identify price having tested a key resistance level to 2050, the 2050 price level. And also at that point, we saw that shift in the dollar, right? We saw that shift in the dollar. This was in March 2022, where the US dollar was gaining massive strength. It was strengthening right across the board for several reasons. Okay, so at this point, we saw on the dollar, on the DXY, gaining strength because of interest rates expectation, right? Expecting interest rates to climb. We saw the Russia-Ukraine war causing the shift towards the dollar, right? We saw all that, but more importantly, more crucially was the interest rate decision. As the US dollar strengthened, that caused gold to weaken. And that's why we saw that reaction at that 2050 level and then that big trade towards the downside. Okay, so this will be an example. Quite briefly, this is an example of a position trade. Hold it for 9 months, one big trade all the way down towards that key round number of 1600. Right? It didn't get to 1600. It came close, and after it bounced back up. Okay, so at that point, right, just to elaborate more on this, take away that scribbles for now. You notice that, as it tests and rejects that level, it would not be reasonable to consider that you'll be getting in right at that point. Most likely, you'll be only getting in right after it closes below that point. Right, this is on daily time frame, so you might have entered a trade right there to sell. Right, with your stop loss above that resistance level and your take profit down towards that 1600 support level. Okay, 1600. If you scroll back, there's a reference point way back. So that would be your position, example of a position trade, expecting gold to trade significantly lower. But this is the issue with position trading. Can you imagine sitting there, getting into a trade in March? It would have made you money through April. By May, you would have come to that point where you break even or even losing some money. Right? So when you're looking at position trading, there will be situations where you'll be looking at profit, and then very quickly, no profit, break even, or even in the loss. But you're not looking at that short-term fluctuation in price. You're looking at that longer-term move or anticipating that longer-term move towards the downside. Okay, so short-term fluctuation, big bounce up, big drop, and then a bounce up again. All that is something that you would have to ignore if you're looking at position trading. You're looking at a long-term trade towards the downside. Now, let me ask you the question, a bit early on right now, but if you're looking at a position trade, what is the one other strategy that would help you secure your position? Is there one method, as you're looking for this big downward move, is there one method to secure your position? And it's actually very important for position traders. Anyone? I'll give you a minute to consider that. Nothing so far? All right. So one very important thing as we get into position trading is the trailing stop loss. Okay, this is one way that you're going to use to protect your trades. You're not looking at a very actively trailing stop loss, right? You're only looking for it as it breaks key levels, then you'll be looking for that trailing stop loss. So for example, as it drops, we have a key level there, right? As it drops, once price breaks below that key level, you move your stop loss down to possibly break even. And then another key level here, right? Once price breaks below or breaks below, so in this situation here or this situation here, you move your stop loss down again to protect from that previous resistance level or support level. Okay, and then as it drops again towards your take profit level, again, you move that stop loss down again. All right, so do bear in mind that it's not just setting and forgetting. You do check back onto your charts once a while when you anticipate some potential moves or changes in situations, and you can actually secure your position by moving that stop loss down as a form of a trailing stop loss. Make sense so far? All right, so with that, it comes to that question. I know that most traders consider technical analysis a lot more than fundamentals, basically because of the way that most traders are trading, shorter term, short to medium term. The technical analysis does play a bigger importance at that level. But when you're looking at position trading, you still do use a combination of both technical and fundamental analysis, but more emphasis is placed on fundamentals. More emphasis is placed on fundamentals, not just in terms of macroeconomic factors, not just the data that's being released in terms of economic data and performance numbers. You're also looking at general market trends and also historical price patterns. What I mean by historical price patterns, that is what I would refer to as your support and resistance levels. All right. Which is where we come to at this point here, your technical aspect in terms of your support and resistance levels. Okay, so you're looking at economic factors, market trends, and price patterns. What's the one more thing that position traders consider quite a bit on? It's also geopolitical stability, right? Or geopolitical instability. When we talk about a shift in governments or war or recession or crisis happening, those are longer term trends that do play out in the longer term. That's where the position trader be looking for that opportunity. For example, when we had COVID in 2020, markets were all shutting down, well, almost shutting down. We had GDPs crashing, we had everything reducing, contracting. That position or that economic environment held on for almost a year. We're only seeing the recovery of that middle of last year, right? So about 1.5 years as we went through that economic scenario. So they do look at economic data, market trends, geopolitical uncertainties, and also any financial crisis, pandemics, wars, all that kind of stuff. Any questions so far? Not? Let's move on. All right, so like I was telling you, key economic data position traders watch. You don't have to pay attention to all the different news events, right? I would say that for sure you would start to ignore, if you're a position trader, you start to ignore employment numbers, right? Because employment numbers are released once every month, right? Sometimes once every week. And those numbers, as they are released so often, it does tend to have that spike and then that retracement, that volatility, that fluctuation there. So example, employment numbers, you ignore, right? You ignore even at some level, the PMI numbers, right? You ignore the retail sales numbers. A lot of economic data you could just ignore. The ones that position traders would focus on, would really drill down to, is interest rate decisions, inflation growth, and market sentiment. Right? Market sentiment, like what we said here, overall general market trends. But don't get me wrong, it's not that you're looking at what is interest rate going to be. Right? You're not looking at whether interest rate is going to go from 2.5, for example, to go up to 3%, right? You're not looking at that. You're not so concerned about that 50 basis points rate hike. You're more concerned about the changes in interest rate decision, the changes in inflation growth, the changes in market sentiment. What I mean by that is you're concerned about if interest rates had been held at 0 for a long period of time, and the central banks start commenting, talking about, or releasing plans to hike interest rates, right? They might not even have done it already. They're starting to talk and releasing guidance, forward guidance about increasing interest rates. So the changes in decision has been holding at 0. Has been holding at 0. That change in decision to increase is going to cause a change in trend, is going to cause a shift in the price or the longer term price movement. Okay. Changes in inflation growth. I can tell you that, hey, the US has been battling with sky high inflation, record high inflation numbers, and only recently it's starting to drop. So we had inflation numbers rocketing high. We saw interest rates climbing. Only when we start seeing inflation growth drop, a change in inflation growth, is when we saw the dollar index starting to reverse towards the downside. Okay. Inflation continuing to climb, giving you similar growth to what it was the last month or the last quarter or the last year, doesn't excite markets as much as a change in the data, a change in direction. Okay. And then market sentiment, very similar story, is all that change. During COVID, everyone was negative, right? Market sentiment was towards the downside because economies were closed, we were in shutdown, we were in lockdown over and over, GDP was low, consumer sentiment was low. Nobody was looking at spending money. There was no travel. Demand for production was low. But when things started to open up, we saw that rebound. So that change in market sentiment caused a shift in the overall overall shift in price direction. Okay, that position. So that when position traders, you don't have to look at all the news. You're looking at this 1, 2, and 3 key news events. And you know that interest rates decision gets released quite often, but changes in interest rate decision takes a longer time. Changes in inflation growth takes a longer time. So these changes tend to last, or the trend tends to last for a long time before the change gets applied. Make sense so far? This is really important. I hope if you can, take a snapshot, keep this, make sure you remember these points. With that, how much time should you have to trade this position strategy, right? Almost sounding like a bit of a broken record. Position trading strategies requires very little amount of time. Okay, you don't have to sit there every day. You don't have to sit there even 3 times a day or 3 times a week. You're only most likely going to tune in when tune in or checking the charts when there's an anticipation, that a change is going to happen. The good thing is when we look at news events such as this 3, these are very widely commented upon, right? So you don't have to know this, you don't have to get Bloomberg, you don't have to get special news telecasting to tell you about a potential change in economic situation. General news events can also give you the information on when we could anticipate or expect a change in economic situation. But bear in mind, with the less time, when you spend less time in front of the charts, right, managing and actively trading, you also would most likely need a larger initial capital, right? You'll most likely also need a larger initial capital. Why is that? It's because because you're looking at trades on the daily or on the weekly time frame. What that means is that, price or the levels that you identify are going to be larger. Your stop loss levels could be larger. And also, if you get into a trade, you're looking to hold that position for 3, or even as we saw on gold, 9 months. If you're looking at a trade for 9 months and you couldn't enter anything else, then you would want to be looking at a larger trade size. So because when you compare, or when you combine that two, bigger stop loss levels, bigger trade sizes, your risk is going to be higher, right? Your risk is going to be higher, which is also why you're going to need that larger capital amount to be able to afford or to ride through that risk. All right. So it's not always, longer term trend, fantastic, easy to trade. It does have a little bit of a payoff to that, or an offset to that, where you might take on a little bit of a bigger risk because of the larger capital amount, larger stop loss levels, and larger trade size. Thank you, Sumit. Thank you, Aji. All right, so we come down to the trading strategies, things to think about and to consider when you approach the markets with the mindset of a position trader. First way I would say, I'll give you an example of, is when you have news events and reaction of key levels, right? So identify the key events that are happening. You don't even have to predict what key events are happening. Identify the key events that are happening and look at the way price is reacting during that time to the key levels. Secondly, another way to approach position trading is look at the previous trend, and then consider the overall sentiment. And we talk about Forex, overall sentiment of that currency. Okay. And then thirdly, if you really had to, you can also use technical indicators such as the MA for the golden cross or the death cross, the MA 50 and the MA 200. Are you guys familiar with the golden cross and the death cross? With the MA 50 and the MA 200? Good stuff. Fantastic. Okay. So let's look at the first example there. You can just use straight up MA, moving average. You don't have to use EMA. Right. So first off, let's look at a news event and key levels. What I have here, I did a review of the, this is the pound dollar, right? The pound dollar. And this was 2022, right? At the start of 2022, price was above that 1.34 price level. It traded there, bounced around. We had a key level there, as we saw from this swing level. This is on the weekly or daily time frame. Okay, and then we saw as that point, this was on the 21st of March, 21st of Feb, where the Russia-Ukraine conflict started. Right, the Russia-Ukraine conflict started, and in the UK being that close to Russia-Ukraine borders, we saw that downward starting to happen. Okay, so again, coming back to this news event and key level. So the news event was the Russia-Ukraine conflict, pushing price down. Key level 1.34 being broken. Okay, so that's where we'd say, okay, that's where we can consider a start of the downward move, right? A position. You'll be there, oh, can I take on a position for that longer trade or longer term trade towards the downside? As it approaches that key level, once it breaks that level, you could be looking to get in either, take that away for now. Right, you could be looking to get in either as it breaks that support level, or you could be a little bit more risk adverse and look for it to break below that previous swing low at that point. Both very close. Okay. Same thing, if you did enter at any of these points, your stop loss will be above that resistance level. Your take profit would be all the way down, wouldn't go to 1.05, but it could be all the way significantly lower. As that happens, we see price trading towards the downside. Very similar to what we were looking at in gold, where we saw price spike up. So very quickly, in a month or 2 months, you could see your position was in good profits, totally retrace before coming back down again. And then in July, we saw the Prime Minister Boris Johnson resign. Geopolitical or political risk causing uncertainty in the UK. Price dropped bounced a little bit before dropping further, right? Extensive tax cuts announced. We saw price drop significantly all the way down to 1.036. And then the Bank of England intervened. That's where, a shift in policy causes the pound dollar to trade back towards upside. So you could see this come down with the introduction of the intervention. You could be looking to close out your trade there. Okay, so that's your swing trade, or that would have been a swing up, no, a swing, that would have been a position trade for last year on the pound dollar, just based on news event with firstly the Russia-Ukraine war, secondly the prime minister resigning, and then thirdly the extensive tax cuts being announced, causing the pound dollar to drop significantly. This would be a trade they'd be looking at towards March or end of March, April, May, June, July, September, all the way through to about October before we saw that big push back up again. Similarly, euro dollar. All right, so now again, this is where we looked at the previous trend. Euro dollar had been pushing towards the downside very strongly. Same thing in 2022, it sat right across at that almost 1.13 level. Russia-Ukraine war happened, and we saw that big drop begin. And that continued on for a long time between March through to July, before the ECB started talking about interest rate hikes. They introduced for the first time for a very long time interest rate hikes, and that's why we saw the euro dollar, although it continued to drop lower, but it pretty much stabilized right at about that parity level. Right, we talked about parity level before bouncing back up again. Okay, so as the previous trend and also the sentiment. When it was dropping, everyone was talking, news analysis was all about sentiment towards the euro dollar getting to parity. And that's why it got to parity. It tested slightly below before bouncing back up very strongly again. Lastly, this is gold as well. Okay, so if I can scroll back up, right, you're looking at trend and sentiment. That was on the euro dollar. Another one about trend and sentiment. This is on gold. You can see that as it bounced off a key level here, At 1676, we saw it shoot up towards 2076. You might not have done anything at that time, but as it rejected that level, trading back down, this could be a bit of a shorter term position trade that you could see it come back down towards your key level, right? And then as it bounces off this level again, you can see it trade back up and then failed to break lower before pushing back higher again. So you don't only have to look at position trading when it is in a trending scenario or downward or upward trending scenario. You could also be looking at position trading when it's in a horizontal range, but it does need to be a big range where you can look at it trading from the top to the bottom and then from the bottom back up again. Is there any difference between EMA and MA when you incorporate across? I haven't tested it out, but I would say typically we would stick to the MA when we're looking at a cross. All right, so looking at a cross, this is where we are. This is on the US yen. Okay, so you can see that once you see the cross, this is when we talk about the cross over here, pushing towards the downside. We're expecting price to trade lower, especially after it's turned down strongly from this point. You could be looking, if you did look into getting in just based on that cross, as you said there, it is a little bit lagging. It does turn back up before coming back down again. Okay, so the risk is there. I wouldn't be looking at getting in just because of a cross. I would combine it with the cross and also a break of a level. Right, so I'll be looking, okay, I would say that great, there is a cross there. Only when it breaks that level, then I'll get into that overall downward move. I expect the overall downward move. And that's where we would see trading back up before coming back down again. Similarly, at that point, you would be neutral because it's hit your position. Although price has climbed up, you wouldn't do anything until I see that cross and I see a strong break of that resistance level. In this case, again, this is to highlight the point where your stop loss is important, because if you didn't have it, you come down quite significantly, you might get stopped out, might have another entry again to trade towards the upside. Okay, so you could be looking at trying that position several times. You might get stopped out once or twice, but you're looking for that overall move towards the upside. Sentiment is generally correlated with MA 200, bullish when it's over and vice versa. Yep, you can use MA 200 as a strong support, as a dynamic support or resistance level as well. And then lastly, this is what we've seen most recently on yen, where we saw a crossover here. Right, I wouldn't have got into that trade at that point. This on a weekly time frame, you'll be only looking to get in. You can have a swing level there, so you're only looking to get in once it breaks above that 17 or 117.59 or 17.60 price level, with that crossover, looking for that significant upside move. Cross signal for the breakout confirmation, right? Yep, cross signal and a breakout. It depends on the integration with major support. Correct. Yes. So exactly that. I think you just said exactly what I was just trying to convey, is that when we look at crossover, you wouldn't get in just because of a crossover, right? As a crossover there, because it is still below that resistance level. I will anticipate that, okay, I've seen a crossover. It is below resistance. Only when it breaks above that resistance level, then I'll be looking for that crossover plus a break above the resistance for that big upward move. Does that make sense to all of you? I think that's the last one I had, the last slide I had there. All right, have you found the information useful? Would you be starting to deploy or to look into deploying long-term position trades as part of your trading strategy? And if you have found the session interesting, useful, informative, I thank you for your comments and feedback. In the meantime, please remember, trade well, trade safe, and possibly in future when I have more capital, but not easy at this moment. Yeah, it is a relatively capital intensive strategy, right? You can, don't get me wrong, you can do it on a small capital, but it's going to be almost not worthwhile, right? Because if you're trading at a very small trade size, and you're holding it for a super long term, you might even end up paying swap on it. And as price moves, I would say that smaller capital, you're possibly wanting to take advantage of the price fluctuation more rather than trying to ride a super long trend. All right. Long trade investment. It's not a big, well, not a, it's almost the same thing. It's a long trade investment. I would even call a super long trade an investment into the period. All righty. So with that said, please remember, trade well, trade safe, take care now, and I will see you again. Bye-bye.